Now, on this one, we're going to turn to Europe, and we're going to look at what are some of the key things that are happening within the European markets. So just going back in time, because remember, I was at a lot of travel, so now we had to go back and walk kind of to where we are right now. So when we look at the composite for the Eurozone, you can see that the expectation was for 53.3, came in at 52.8. So this is that gradual slowdown. The problem is there's that tale of two cities, because the manufacturing is pretty steeply in contraction, but the service side continues to be fairly robust. Now, it was expected at 55.9, came in below estimates, but again, it was still 55.1. So you're not looking at this massive slowdown yet on the service side, but then when you start looking at some of the data points, how the consumer is going, how wages are looking, how costs are going, that's where we get that concern going forward, which the ECB and Draghi has, and Lagarde has been talking about, which you're starting to see Draghi. I'm going back in time. And Lagarde has been talking about in terms of that pressure that's mounting not only on the corporate side, but more on the consumer side, which is really the only thing still holding things up. Now, Germany has officially gone into a recession. There's views that now that means that all of the EU is in a recession. But even when you look at Germany, when you look at the EU, it's not like we're in this steep, we're down 5%. It's negative, but it's not a steep negative side. And the problem that I had, going back to what we talked about in the IMF and in the World Bank expectations for GDP, they're overstated because, again, Germany, Europe, it's just one of many that are going to continue to slow down and continue to see some of these pressure points. And we'll talk about it in a minute, but when you look at some of the data from China, and when you look at what China's talking about, they're talking about stimulus and all these things. It's like, well, you're not going to do stimulus if your economy is doing really well. And again, and to China's point in that regard, they've been doing stimulus for over 10 years now, just like everyone else. I'm not saying that China is unique in that aspect. They've been doing way more than others in terms of just the amount of stimulus, and that's the problem, that law of diminishing returns. Every new dollar has a diminishing util until eventually, no matter how many new dollars you throw at it, it has a negative util or a negative impact to the economy. So again, we're reaching those points. Investor confidence flagged further, came in at negative 17, below estimates. PPI though, a nice, starting to see a little bit of a balance. The expectations were for negative 3.1, came in at negative 3.2. And remember, that is a key component of where is inflation going to go going forward. Now, the concern that we have, which is something that we've been talking about, is that as we got into the summer months, natural gas prices were going to reverse higher. You were going to have some electricity shortages, and that is coming to pass. And it's Norway is shutting down their largest gas facility. And you're starting to see this compounding problem, which is why we think PPI is going to be very lumpy. It's going to be driven based on what are input costs going to look like, and that's going to be driven by weather. And that's why it's going to be very difficult to kind of plan what this is going to look like, and again, why some of these companies are leaving Europe. Retail sales, again, speaking to that slowdown, they were expected at 0.2, they came in flat, but the previous month was revised a bit higher. So you're still in this crux, but you can see there's that slowdown. The rate of change is heading negative. It's accelerating, and that's why we do see that pain. GDP for all of the Eurozone was expected flat, came in at negative 0.1. And again, that's where we continue to see those pressure points as the government expenditures came in negative. Household consumption expected to be at negative 0.5, came in at negative 0.3. So, but again, that was Q1, and it's again coming to the consumption side, and we see that accelerating just based on where retail sales were in April, where they're expected to be in May, based on some of the leading indicators that we've talked about. The survey expectation for ZEW came in at negative 10, another acceleration to the downside. Industrial production, kind of flattish, not a huge shift one way or the other. Trade balance came in negative, but then when you look at the ECB and the refinancing rate, lending facilities, they continue to move up a quarter point, and that's what we expected when you look at what happened in yesterday. And one of the things that was talked about is that they're not done. And I think that's the biggest miss when you look at some of the commentary, some of the views on economic strength. It's like we are so far from where we're going to be in terms of inflation or what the targeted inflation is. Now, you're starting to see some good indicators especially in Europe, less so in the US, but more so in Europe. And it's really because Europe had such a massive move on the energy front, driven by Russia, Ukraine, driven by the cost of LNG and the cost of importing. Now, the problem is they had this big, gigantic spike up, and that spike has come down pretty quickly on the input cost side, but they still have to import. So that's why when we talk about this, we talk about how the flatlining is going to be much higher because importing by water, diesel, gasoline, LNG, natural gas in general, is more expensive than piped. And that's where the piped is now gone, or at least very much diminished, which is why we're going to have those settling higher, which the ECB is aware of, and some of the things they're trying to get in front of. So then when you start looking at the retail sales volume, that's the trend we're talking about. It's yes, it's still positive, it's still up, but you can see where we're going, and you can see the movements down and the pressure that we see continuing onward. When you look at the euro area and the composite PMI and the money supply, that's where, again, they need to pull these things down. But the problem when you just look at M1, M2, it misses the whole story. You're talking about a region that had significantly negative interest rates. That there's a lot of really cheap debt out there. There's a lot of froth that's sitting around that they have to pull out. And again, that's why realistically, we believe that the manufacturing side has been hit a bit harder. The manufacturing side has been hit harder. But then when you look at retail sales, it's going to continue to come down. And that's where that movement to the downside will accelerate. Now, just picking on Germany, the trade balance was slightly better in April. Exports came in at 1.2 versus the estimate of negative 2.5. But imports were expected to be negative 1%, came in at negative 1.7. That's some of the concern. It is just where, the future of things, because imports coming down more than estimates, remember, has that leading indication of not only internal demand, but also what the exports are going to look like. Because typically, Germany is an exporting nation, so they import semi-finished goods, raw materials, export the final product. And that is going to have some of that slowdown. Germans on the service PMI side expected to be at 57.8, came in at 57.2. But the composite was expected to be at 54.3, came in at 53.9. And again, all of that is driven by the manufacturing side. So factory orders were expected to be up 2.8, came in at negative 0.4. Year over year expected to be at negative 8.4, came in at negative 9.9. So again, that's that acceleration to the downside, but the services is still hanging in. That's starting to roll. And the concern that we have, especially when you look at Europe, is they're already in a recession. And again, small, but it's being driven by the factory side, the manufacturing side. But what happens when that service side catches up? And that's why we do see more pain in Europe and more downward momentum on GDP and underlying growth. Now, when we look at the CPI expected to be at negative 0.1, came in at negative 0.1, year over year still at 6.1%. When you look at expectations, ZEW survey expectations came in at negative 13.5, negative 8.5 versus the estimate of negative 13.5. Current situation came in at negative 56.5, well below expectations. So you're starting to see some of those shifts, but the stickiness is you've had this sizable slowdown in manufacturing, but you still can't get CPI meaningfully lower. And 6.1% on a year-over-year basis is a big problem. And when you're only seeing month-over-month declines of 0.1, again, you need to see a bigger acceleration to the downside because they're still so high. There's still that momentum. Now that we're coming into summer, things are expected to be fairly warm, especially as El Nino increases in intensity, as we talked about in segment 1. And again, that's going to put more and more pressure. Wholesale prices, though, came in at negative 1.1%. Last month, they were negative 0.4%. So that is a good acceleration to the downside, which should help. But remember, that's May. So it's going to be interesting to see what happens with June as we've seen some of this pivot on both electricity prices as well as natural gas prices, given the importance of that input specifically in Germany. And this just gives you an idea of manufacturing orders. They came in at 94.8, well below pre-COVID levels. You see the bump from post-COVID, and now you're starting to see that roll over and that pressure that was coming in. And one of the things that we talked about in 2019, for those that have been following us based on insights or on the shows, is that we were concerned going into 19 because you can see how it was just essentially bumping along the bottom, and we started to see some of that rollover, and now we just have that catch up. Capital manufacturing orders, capital goods, when you look at the came in at 92.4, and again, that acceleration to the downside is going to continue. It'll start to flatline just because you will get some new orders, but again, that's where we get some of this pressure, and this is what's driving the decline. This is what's driving the quote unquote recession. The next question is what happens when the service side and the consumer starts to feel that pain at a greater level and slows down considerably, because right now it's really only the consumer and services that are holding things up. And that's something that we see unwinding further. Well, now when we turn to France, PMI was expected at 51.4, came in at 51.2. Services was expected at 52.8, came in at 52.5. So when you look at France, that's where you're starting to see a bigger acceleration to the downside on just underlying growth, where Germany's still on the composite at closer to 53. All of that is driven by services in Germany. But when you look at France, French services and manufacturing are lower. Well, I should say services are lower, but manufacturing is a bit higher, which is what's kind of giving this balance. But all of them are still indicative of a slowdown. When you look at CPI, again, coming in at a weaker point, so you're really not finding any pocket of strength within Europe, which is why we see some of this acceleration to the downside. Spain is just another example. Composite came in at 55.2. Services came in at 56.7. But when you look at industrial output, negative 4%. When you look at home prices, came in at positive 0.6. But they're just kind of bouncing around as house transactions came in on a negative front. But the issue here is CPI on a month-over-month basis was expected at negative 0.1, came in flat. So you're still seeing that different pockets of inflation, which is making it very difficult to see any type of movement or meaningful adjustment, which is why we believe the ECB is going to continue raising rates. It's going to put more pressure on the consumer, and again, bring down some of this growth underlying in general. Italy composite was expected at 54.6, came in at 52. Services expected at 57, came in at 54. Retail sales expected at 0.3, came in at 0.2. But again, that's for April, which if you just look at the PMIs for May, you get that acceleration to the downside once again. Industrial production expected at 0.2, came in at negative 1.9. And that's the problem and concern that we see specifically in Italy, where Italy was holding things up pretty well, and now they're really starting to kind of accelerate or catch up with, if you will, to Germany. And that's again why we see this downward pressure, these downward revisions. Now, the impact of the redeeming of the TLTROs, the bank liquidity as measured by the liquidity coverage ratio, or the LCR, is expected to decline sharply over the next 18 months as approximately 1 trillion of these products are set to be redeemed. And again, that's going to be that pressure point, which is, if you remember when we were talking about these different structures, Italy was a massive buyer of them. And now that as they get redeemed, you're going to see them fall below, which is why we continue to see Italian debt not properly pricing in the pressure that is there versus some of these other areas. Now, the strong service area keeps the ECB worrying about upside price risks, which again is why we see the ECB going higher. The service PMI, the output prices, All of that is a problem when you look at some of these movements. Now, given they're starting to turn, but they can't take their foot off the accelerator just because we're still so much higher versus going back to 2004. And there's still those issues with those input costs that they're going to try to get in front of in some way, which is why we see more pressure in Europe. Eurozone policy rate forecasts, as you can see, there's an expectation of that walk up. So again, I'm not alone in saying this, but just like we talk about in the US, something similar is they're going to have to keep it elevated. They're not going to see this big drop down. And the outlook suggests that unit labor costs will rise faster than selling prices, again, putting more pressure on the manufacturing front, the labor front, which is why we're going to see those rates. Euro area GDP coming in negative two quarters in a row, which again gets us to where we are in terms of being in that official recession. You know, you can make the argument that that consumers are still strong. I would say, and because they made that comment in the U.S., I would adjust that a bit, just because even though we had 2 periods of decline in the U.S., a lot of that was driven by inventories. A lot of that was driven by some one-offs, where on a manufacturing and service side and consumer front, they weren't terrible. Where here, yes, services is a bit stronger, consumers a bit stronger, but manufacturing is much worse than it was in the U.S. And again, that's why I think we're comfortable in saying that they are in that recession. You know, the expectations of economic growth, you know, flatlining around here, but the current situation's deteriorating. And I think as you see some of these pressure points get priced into the system, you're going to see another walk back in some of that industrial production in Italy. That's the kind of the big miss in that acceleration, because when you look at the trend, even though obviously it's lumpy, the trend is still to the downside. And then the lower EU's Eurozone inflation expectations foreshadow slower wage growth, which is typically what should happen. Wages, you know, because of those labor shortages, you still have a little bit of stickiness, but that's what they want to get in front of. They want wages to slow down, and that can only come with more aggressive rate hikes, which is why we see this continuing to go up at least 2-3 times before we get any kind of pause. So that's what we have for you in Europe. In the next segment, we're going to go deeper into China and Asia and some of the things that have happened over the last few weeks.